If you're looking for the potential of strong growth, great diversification, while minimizing the tax drag on your portfolio over time, the ETF SCHG may be one of the best options available in the market. And in this video, I'm going to break down everything you need to know about this ETF, and all I ask before we get started is if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. Now, to get straight to it, SCHG stands for the Schwab Large Cap Growth ETF that is managed by the company Charles Schwab, where the investment is traded as an ETF, which means you can buy this fund on nearly any investing platform that you use. SCHG is also considered an index fund because it passively tracks a certain market index, where you can see the fund's goal is to track as closely as possible the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. All that means is that in the click of a button, you will gain access to some of the largest US stocks that exhibit growth style characteristics, where it states SCHG has a total of 229 holdings inside of the fund. Now, the Dow Jones has a ton of factors that contribute to what companies are eligible to be selected, where they state the classification of growth or value style companies are based on 6 measures: 2 projected, 2 current, and 2 historical. That includes the PE ratio, projected earnings growth, dividend yield, and many others that go into the calculation for what's included in the index. Something else important to understand is that a fund like this is considered market cap weighted, which means the companies in the fund are given their weight based on their size. For example, the top holdings in SCHG consist of many companies that you probably heard of, where the top ones are Microsoft, Nvidia, and Apple, that contain the largest weight toward the fund, being roughly 30% among just those 3. Largely due to this structure, SCHG has roughly 45% of the entire fund being in the technology sector, and because of that concentration, SCHG does come with more risk, but also the potential for a higher reward. In fact, the standard deviation for SCHG is currently stated to be just over 18%, or the S&P 500 ETF VOO is roughly 15.5%. Aside from that, SCHG also has a 54% overlap with the S&P 500, an expense ratio of 0.04%, which is very cheap and means that for every $10,000 that you invest, it will cost you $4 per year in fees, which the fees are automatically going to be taken out of your investment over time. It's not something you have to pay separately. On top of that, SCHG also has a low dividend yield of 0.4% over the past 12 months. And the reason I mention this is because if you are investing in a normal brokerage account that is taxed, the dividends are going to trigger capital gains that you have to pay taxes on, no matter if you reinvest the dividends or not, and that can significantly impact your portfolio's returns over time. For example, let's say that you have $100,000 invested and have 100% of that in SCHG, where you trigger 0.4% of that in dividends every year. Or say you have a dividend fund like SCHD that may trigger 3.9% in dividends every year. That means either $400 or $3,900 would be added to your taxes every year, whether you reinvested the dividends or not, and as your investments grow over time, that impact becomes even greater. Now, there's nothing wrong with SCHD. I actually believe it's one of the best overall dividend ETFs in the market. It just depends on what you're looking for. I say that because if you're thinking of investing for a long time in a taxable account, the tax rate could significantly eat away at its value over time. You see, on a $500,000 portfolio averaging 7.5% per year, a tax drag between 0, 1, and 2% can easily end up costing you hundreds of thousands of dollars in future gains. So not just do taxes add up by the end of the year, but compounding your investments over time has even more costs associated with it that you may not realize right now. And since learning that, I've really started to focus on any long-term investments in my taxable accounts to be as tax efficient as possible. But as far as the performance for SCHG, over the past 10 years, the fund has averaged 15.88% per year. Over the past 5, it has been 18.23%, and the past year alone has been 17.22%. Not to mention, but when compared to the S&P 500, SCHG's best year over the past 10 years went up 50% in value, where the S&P 500 was 31%. Its annualized returns here are 17.28% when compared to the S&P 500 at 13.88%, but the worst year was worse, being down 31%, when compared to being down 18% with the S&P 500. So like I said, the volatility is greater for a growth-oriented fund rather than the S&P 500, which is why there's typically going to be more risk, but the offset could be for more potential reward. Now, I will say there are 2 other strong alternatives to consider besides SCHG, and that is QQQ. Alternatively, the cheaper version is QQQM, and then Vanguard's ETF VUG. End of the day, all 3 are very strong options, which makes it a really hard choice to decide on. So if you want want to learn more about each, I'll have more videos that I created on them linked in the description below. I'll also mention that I've created an entire index fund cheat sheet covering the differences between these index funds and many of the other top options available in the market, which I'll also have linked in the description below if you want to check that out. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.